All right, welcome to The Explainer. Today, we are diving deep into a really high-stakes question for Chinese restaurant brands, expanding into the U.S. market. You know, for entrepreneurs and investors who are battling it out in China's super competitive food scene, America, it looks like the next great frontier, right? But here's the big question. Is it really a land of opportunity, or is it just a minefield of hidden costs? Well, the thing is, the answer isn't a simple yes or no, not at all. It really comes down to one thing: strategy. And that's exactly what we're going to break down for you today.
So to really get why this is so tempting, you have to start with the money. I mean, the financial upside is just staggering. This one idea that a single successful US store can be worth 10 or even 15 stores back in China, that's the engine driving this whole trend. We're not just talking about selling more bowls of noodles, we're talking about a completely different level of value creation. So let's figure out how to navigate this high-stakes game.
Okay, here's how we're going to tackle this. We'll start with the big gold mine or trap question. Then, we'll dig into why America's restaurant game is so different. We'll look at some new brands that are actually succeeding, do the billion-dollar valuation math, and then wrap it all up with a U.S. expansion playbook you can actually use.
All right, first up, let's unpack this core paradox. Is the U.S. market a gold mine or a trap? Let's get into it.
So before we even start dreaming about the gold, we have got to understand the trap. Because the U.S. restaurant industry, it's a completely different ballgame. It has its own set of rules. And for anyone used to the market in China, trying to just copy and paste a successful model over here, that is an absolute recipe for disaster. Let's break down exactly why that is. Okay, the first, and you could argue the biggest, hurdle is labor. Just look at this number, 80%. That's the annual employee turnover rate in the U.S. restaurant industry. I mean, just think about that for a second. It means your team is in a constant state of flux, always changing. And all that constant churn, it comes with a very, very real price tag. We're talking almost $6,000 just to replace one employee. That cost, all by itself, can absolutely cripple a new business before it even has a chance to get off the ground. And it doesn't stop there. On top of the turnover costs, your baseline pay is just structurally way higher. You take a city like New York, for example, a $15 minimum wage sets an incredibly high floor for your operating costs right from day one. You put all these labor realities together, and it puts this immediate, intense pressure on your entire business model. Now, this table really lays it all out, doesn't it? It shows the huge strategic shift you have to make. You see, in China, the game is so often about speed and scale, that whole Palmer quandary or land-grabbing mindset. But in the US, that's just impossible. The costs are too high, it takes too long to open a store, it forces you to completely change your game to one of value and efficiency. It's all about maximizing the profit from every single store.
Okay, so after all those challenges, you might be thinking it's impossible. But a new wave of brands is actually proving that it can be done. And they're not just surviving, they are putting up some incredible numbers. But, and this is a big but, their success comes with a really important strategic lesson that we have to unpack.
So let's take a look at a brand that many of you will definitely recognize, Zhongliang Malatong. You know, after basically saturating the market in China, they decided to enter the US. And wow, the results from their very first store are pretty stunning. Just get a load of this. Their one store in New York is reportedly pulling in about $280,000 US every single month. This is proof positive that the single-store economic model in the US can be unbelievably powerful. And hey, this isn't just about hot pot restaurants. We're seeing it in the crazy competitive tea space too. A brand called Jasmine Milk White is another one that's just seeing explosive growth. And this just brilliantly illustrates the sheer potential for revenue. I mean, $500,000 in monthly sales from one single location, that is a phenomenal result. It just goes to show you that consumers are absolutely hungry for these new, authentic concepts. Okay, so here's the crucial point. We have to understand how they're pulling this off. And let's be really clear, these brands are not winning in, middle America. What they're doing is executing a classic beachhead strategy. They're going into areas with a huge concentration of Chinese and Asian customers. Think Flushing, New York. And they're dominating. They're basically winning by replacing the older, maybe less professional local spots long before they even think about trying to cross over to the mainstream market. All right, now let's talk about the real prize, the big why. The reason investors are willing to jump through all of those operational hoops. Because it's not just about the profit you make from each store. It's about the total value of your company in the capital markets. This is where things get really interesting.
Honestly, this slide pretty much says it all. You take a 200-store chain in the US, even one like Sweetgreen, and it can command a billion-dollar valuation. Now compare that to China's current capital environment. A chain of a similar size, even one with great revenue, would be valued at a tiny fraction of that. And this has nothing to do with exchange rates. We're talking about a fundamental night-and-day difference in how the market values these businesses.
And here's the simple math that explains it. It's all about the valuation multiple. That's basically the number you multiply your profits by to get your company's total worth. And in the US, that number is just dramatically higher. A typical US chain could easily get a multiple that's double its Chinese counterpart. And if you have a real high-growth story, like a Chipotle, whoa, that multiple can soar into territory that you usually only see with tech companies. And here's the kicker. You don't need to build some massive 1,000-store empire to get a payout. The US has a really mature and active private equity market that specifically looks for restaurant chains. So if you can just build a small, super profitable chain of, say, 3 to 5 stores, you suddenly become a very attractive acquisition target. That gives founders and investors a clear and very lucrative exit path. So, okay, we know the challenges are huge, but the rewards are incredible. So what does a winning strategy actually look like on the ground? Let's build that playbook step by step. Look, the smartest way to do this is a patient two-phase approach. Step 1, establish your beachhead. You launch your first few stores, you prove your concept, you perfect your US operations, and you build up strong cash flow in a friendly market like a dense Chinese community. And only after you've nailed that, when you have a proven, profitable, and repeatable model, should you even think about attempting the much, much harder second step, crossing over to the mainstream. And at the CEO and board level, this means a total shift in mindset. You have to understand this isn't a quick little expansion project. No, this is a brand new startup, and you need to be thinking with a 10-year time horizon. You have to give your local US team real autonomy to make decisions. You absolutely need a war chest of capital because this is going to be slow and expensive. And from day one, you need to run the business with clean books and standardized operations as if you're preparing to sell it to a professional investor tomorrow. So that brings us right back to where we started. Is the US market a gold mine or a trap? And the answer really is that it's a gold mine, but it's a mine that is buried very, very deep, and it's incredibly difficult to get to. The opportunity is absolutely real. It's immense, but it is not for the impatient and it's not for the undercapitalized. Success here belongs to those who are willing to trade that copy-paste, rapid expansion mindset for a long-term strategy built on patience, on localization, and on deep value creation. So the real question for every entrepreneur and investor out there isn't, is it possible anymore? The question is, are we truly prepared to do what it takes?